And good morning from our global headquarters in New York. I'm Sonali Basak in for Danny Berger, and welcome to the Bloomberg Brief. And let's set your agenda for today. U.S. stocks are wrapping up the first quarter, trailing the rest of the world by the most since 2009. The rout continues as tariff day looms. And the CHIPS grant is in limbo. Commerce Secretary Howard Lutnick may withhold CHIPS Act funding to push firms to expand U.S. projects. And SoftBank is set to be seeking as much as $16.5 billion to fund AI investments in the United States. But first, let's get a check on markets here in the United States. We are seeing futures trying to take a breather here, briefly up, but really flat for the S&P 500. NASDAQ getting a little bit more of a lift by the tune of 0.1%. Russell 2000 just as flat. You are seeing bonds, however, still getting a bid with the U.S. 10-year yield firmly below 420, now at 417, another 3 basis points lower on the day. The 2-year down by 1 basis point. I also want to take a look here at Eurozone CPI because preliminary March core CPI rises 2.4% year over year. The estimate was 2.5% year over year. And of course, preliminary March consumer prices have risen 0.6% month over month, while March consumer prices have risen 2.2% year over year. You are seeing a bit of a reaction here in the euro, but not by much. It's still hanging out at about 1.08 against the dollar. We're also now going to move on. We're going to keep an eye here on the top headlines of the day, including Live Nation, because President Trump signed an executive order on Monday aimed at cracking down on ticket scalping and fees that drive up the cost of attending live events. And there's Newsmax. Newsmax is extending post-market gains after closing with a 735% surge on its trading debut on Monday. The conservative media outlet raised $75 million in its IPO. And finally, Johnson & Johnson, a federal judge rejected the company's third attempt to use bankruptcy to set up a trust fund to pay women who claim they got cancer using the J&J baby powder. And we're going to turn back now to markets because joining us now, BlackRock's Vasiliki, Pachatouridi, of course, to react to what's happening in Europe, what's happening here in the United States, the relative value to find amid it all. You're looking at that tremendous bid in the bond market, particularly here in the United States. Does that make sense to you?
Good morning, Sonali. Thank you for having me on this. Actually, it does not. I think where we are obviously now, the big event for markets is the reciprocal tariffs that we are expecting tomorrow. And it is important to kind of level set and say that tariffs are going to be a permanent feature in this U.S. administration. They're here to stay. Of course, a number of different rates will be applicable. Some countries, different sectors will get different rates. But ultimately, we do expect the average U.S. tariff to land somewhere in the region of 10%. Tomorrow is going to be a big day, not a clearing event. There are going to be more questions, more uncertainty, more negotiation to come. But what it means for markets, actually, we think rates are going to edge up higher. Actually, the opposite of what we're seeing in U.S. Treasuries year to date and in the last couple of sessions. And we also think that we're going to continue to see rate-induced volatility. And what it means for portfolios is we continue to emphasize the importance of income, generating diversified, consistent, and high income, as opposed to relying on interest rate risk that arguably is not going to be a good diversifier in portfolios today.
Do you feel the same way about euro area bonds at this juncture as you do about U.S.?
This is an interesting question, Sonali, because obviously up until last year, duration was your friend in Europe. And this year, with the other big policy shift that we're seeing in Europe, with a German fiscal spend kind of announced, we think that Europe has the potential to face a similar situation with the U.S. in the regards that we do expect Eurozone government bond rates to edge up higher. This is on the back of the fiscal spend, on the back of fears around growth and investors requiring more compensation for owning long-dated bonds. So a bit of a shift, but of course the ECB is on a different path. I mean, we saw obviously the inflation data this morning pretty much in line with expectations. Inflation is less of a concern, but obviously kind of fears around tariffs, growth, economic data are weighing on the ECB, and we're seeing probably April cut coming back on the table. We expect 1 to 2 cuts from the ECB this year, but definitely coming up to the end of their rate cutting cycle. But in terms of positioning, what do we like? We like front end yields, but more importantly, we like European credit.
Now, what does this mean for your expectations also for U.S. rate cuts? Do you believe that the Fed will be able to achieve at least 2 or even 3 as the market has been pricing in more recently?
Yeah, I mean, the Fed obviously cannot act preemptively on kind of tariff-induced inflation. They cannot act preemptively on growth fears. And they're somewhat constrained in what they can do. Obviously, inflation is still kind of a sticky point. They could react, obviously, if they see a deterioration in the labor market. But I think to my earlier point, I mean, the hard data are still not painting the picture that the bond market is painting, which is a picture around kind of recession and the expectation that the Fed is going to step in. They will not. And that's why we continue to be positioned at the front end of the curve when it comes to U.S. Treasury rates. And this is when looking at bond ETF flows as well. The majority of flows this year has been going into treasuries and broad market exposures. But as I said earlier, we do want to continue emphasize income generation in portfolio as opposed to pure interest rate risk.
Yeah, to that end also, you look at the U.S. 10-year, and we are pretty far away from the nearly 4.3% that we saw just a little bit earlier this year, just really weeks ago. We're at 4.17 right now. What do you make of fair value on the 10-year? It's pretty stunning to see both investors get concerned about tariffs, potential inflationary pressures, and see the 10-year bid down this drastically with the fear around growth.
Yeah, I mean, I think if we continue to see that level of kind of yield rally in the U.S., at some point, I wouldn't be surprised if investors see that as an opportunity to reduce exposure to U.S. Treasuries and shift more into, as I mentioned earlier, into kind of parts of the market where they can rely more for carry. And we definitely, this is what our preference is. This is where our strategies in fixed income focusing right now. We just launched our first actively managed fixed income ETF in Europe that is focusing on generating income through a variety of sectors. And I think that's also what's important right now, to take opportunities across the universe of fixed income exposures. Corporate bonds, high yield securitized assets, floating rate bonds, because the U.S. Treasury market is going to face volatility and challenges ahead.
Vasiliki, when you're thinking about owning credit, especially across Europe, what is heavily exposed, though, to tariff threats? Presumably, there are many companies that will feel the pain.
Yeah, I mean, when we think about tariffs per se, I mean, tariffs, they will have an impact on companies' profitability, but I don't see the tariffs having an impact when it comes to kind of rising default rates, for example. So in that regard, I see very few things becoming contagious for European credit right now. Obviously, spreads are tight, but as I said earlier, carry is still very attractive. And credit has gone through a lot the last couple of years, and they have really powered through in the way they have restructured their debt, in the way they responded to geopolitical events. So we really kind of believe that it is a good place to be, staying at the front end of the curve. But also something very interesting about the European credit market is we're seeing euro curves steepening, which we haven't seen since kind of pretty much the Q3, Q4 of last year. So that kind of ability to generate more income as opposed to sitting in cash, it's an interesting point. And that's why we're seeing investors stepping into fixed maturity funds and ETFs where they can lock in that yield, but still have funds available if they need to take risk off. And that's why we've seen more than 7 billion going into fixed maturity ETFs year to date.
BlackRock's Vasiliki Pachatouridi, thank you so very much for joining us this morning ahead of what Trump is calling Liberation Day. Of course, a lot of tariff news will be hitting the tape. Now, To other top stories trending on the terminal this morning, U.S. automakers are making a last-ditch effort to sway President Trump to soften those incoming tariffs. Bloomberg sources say that Ford, General Motors, and Stellantis are lobbying the administration to exclude certain low-cost car components, such as electric wiring. And President Donald Trump signed an executive order aiming to crack down on ticket scalping and fees that drive up the cost of attending live events. The order is similar to former President Joe Biden's move that targeted junk fees and pushed transparency in ticket pricing. And Goldman Sachs has drawn more criticism for the $80 million bonuses that it plans to give the bank's top two leaders, David Solomon and John Waldron. Institutional Shareholder Services, a proxy advisor, is urging investors to reject the awards at an annual meeting. Coming up, the arrival of Trump's tariffs looms over global markets. The latest on the president's plans next. This is Bloomberg.
Reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Now, President Trump is set to unveil his reciprocal tariff push during an event at the White House Rose Garden tomorrow. But the extent of the levies still remain unclear. We're going to bring in Bloomberg's Oliver Crook for more. Ollie, what are we expecting tomorrow? Have more details emerged? Do we know if kind of the worst imagined from investors, universal tariffs, are seriously on the table?
So I think there is certainly the possibility of universal tariffs in terms of hitting all the sort of specific countries with these so-called reciprocal tariffs. I mean, as far as the Europeans are concerned, you really have to think about the industries that are most effective. And we should remind people that the EU and the U.S. trading relationship, it's worth about $1 trillion every year, and there's a trade deficit in the favor of the European Union of about $200 billion. What we do know that we're going to get tomorrow is these auto tariffs and the tariffs on the pharmaceutical sector. And when you think about the exports that come here from Europe and go over to the United States, 23% of those are pharmaceutical, 10% of that are the auto industry. So it's going to be very front and center. I think what the Europeans are really going to be looking at, however, is basically the methodology of how the Trump administration is looking about this. Is this just about closing the sort of trade gap that exists on various goods and items, or are they going to be bigger about it? Are they going to think about things like value-added tax? Are they going to think about other ways that they might want to impose their own policies on European policymakers? And that is what they need to prepare for. And we heard from Ursula von der Leyen, the president of the European Commission, just about an hour and a half ago. Have a listen to what she had to say.
So many Europeans feel utterly disheartened by the announcement from the United States. Let me be clear. Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity.
I think it's notable that they're not moving with excessive haste. They don't have their list out yet, but they're really prepared for a fight if they need to fight it. And it seems like, I mean, we'll find out tomorrow at 8 p.m. our time from the Rose Garden tomorrow. The European policymakers are really bracing for, potentially a trade war, but we'll have to see.
Let's also move on to talk a little bit more about geopolitics as well, because we did see President Trump dial back his criticism of Russian President Vladimir Putin, and instead he had accused Ukraine of attempting to renegotiate an economic deal with the United States. What is the latest?
Yeah, what I think is really interesting about all of these is it's hard to sort of disentangle all of these things for European policymakers because they have all of these issues that they're dealing with, whether it's the trade war with the United States, they have the war in the Ukraine, they really need the United States on side for that as well. So, all of these sort of policy issues seem to sort of come together. What we heard from the president over the weekend was after an interview that he had with NBC on Sunday saying that basically, his words, that he was very pissed off with Vladimir Putin because there seemed to have been some indication that Putin wanted to remove Zelensky, he wanted to put Ukraine under sort of a UN temporary-led sort of government in the interim for an election. And basically, Trump saw this as basically a stalling tactic and basically trying to get out of the deal. Then we heard again from yesterday, and again, the Trump position on this has been very clear from the beginning. They're really very concerned with getting a swift end to this war. And then he sort of softened that stance a little bit, saying that Putin seems to be wanting to go in the right direction. But again, with so many of these things, until these conversations actually happen, it's very hard to get a read of what's going on in the background. Though, Shonali, something that I will sort of push us all forward to a little bit later this week is we have this EU and NATO leader foreign ministers meeting that is happening in Brussels. We will have Secretary of State Marco Rubio here. It'll be very interesting to see what the messaging is from the Secretary of State, particularly after those signal chats, and we had sort of some of the views of the Trump administration on the Europeans, but really sort of what the future of NATO holds really in the balance at the moment.
Absolutely. I'll be looking forward to that Rubio readout. That is our own Oliver Crook. Thank you so very much. Now, coming up, a look at what else is making headlines around the world. Stick with us. This is Bloomberg. This is the Bloomberg Brief, and I'm Shonali Basak in New York. Time now for our front page news, a look at what's making headlines around the world. First up, on the Wall Street Journal, the leader of France's National Rally Party and the favorite to win the next election, Marine Le Pen, has been convicted of misusing EU funds and barred from running in the 2027 presidential elections. President of the party, 29-year-old Jordan Bardella, has said he would run for president if Le Pen has asked him to. Next up, on the Washington Post, the Trump administration is targeting billions of dollars in federal funding to Harvard. That includes $255 million in contracts between Harvard and all of its affiliates, as well as $8.7 billion in multi-year grant commitments to Harvard and its affiliates. And on Bloomberg, Commerce Secretary Howard Lutnick is signaling that he could withhold promised CHIPS Act grants. Bloomberg sources reveal that Lutnick is pushing companies in line for federal semiconductor subsidies to substantially expand their U.S. projects. For more, we're going to bring in Bloomberg's Tom McKenzie joining us now. TSMC, NVIDIA, they've all front-run this with investment talks, huge ones here in the United States. Now, which companies might be on the hook?
Yeah, Shonali, absolutely. Look, TSMC came through with that, $100 billion of additional investment on top of investments already committed to the US market. And certainly it seems like the Commerce Secretary, according to our reporting, is looking at TSMC as a case study in how to extract greater investments and more commitments from these semiconductor companies and using leverage within the CHIPS Act that was signed in 2022 to do that. So from our reporting, what we're hearing is that the Commerce Secretary wants to and is considering withholding shifting some of these subsidies to some of the companies on which some agreements have already been made in terms of the funds around the CHIPS Act to ensure and to try and pressure them, essentially, to ramp up their investment by tens of billions of dollars. That's the stick approach. The carrot approach is that the Commerce Secretary is also, we're hearing, considering expanding the credit, the tax credit that on many metrics is actually more valuable to these companies. 25% tax credit. He is open to expanding that tax credit. That would need Congress and congressional approval, but apparently that is a possibility. So the carrot and stick approach being taken by a Commerce Secretary who clearly wants to ramp up the investment numbers from semiconductor companies that have already committed under the CHIPS Act to about $400 billion worth of investments in terms of building out their footprints, whether it's foundries or R&D in the US.
Now, I want to stay on chips for a minute here, but go internationally. China, Japan, South Korea have all agreed to work together to maintain their chip supply chain, and that is in the face of impending tariffs from the United States. What do we know?
It's a pretty fascinating development, isn't it? And there's still a lot of detail that needs to come through. But the fact that these three countries with their historical enmity have sat down together to talk about supply chains, to talk about having a deeper dialogue around export controls and potentially also a free trade agreement at some point in the future is an indication of how the tariff regime emanating from Washington is having global impacts, even on countries that, again, historically have had huge and deep underlying tensions. And those tensions remain, of course, not just between China and Japan, but between Japan and South Korea as well. So the three sitting down, potentially looking at easing the supply chains. They need each other ever more, given the potential impact of those tariffs that Trump has suggested he would hit the semiconductor industry with. You've got companies like South Korean companies looking to ensure that they have the raw materials from China, and China, of course, looking to ensure it still has access to some of the semiconductor machinery and chips that it's still able to import.
I want to zero in on Japan, particularly SoftBank here, because when it comes to the gobs of money that are planned for U.S. investment, they are seeking now a record loan for that growth in the United States. It's a $16.5 billion loan they're seeking. How do they intend to drum this up? Is there going to be huge demand?
Yeah, quite the gob of money, as you say, Sonali. Look, this is something, of course, Masayoshi Son is quite familiar with. It would be their biggest loan that they've had. But, of course, he's pretty used to going to the banks in Japan and internationally raising funds to put to use in his big bets on some of these key themes. And Kitley, he has been going all in on AI, leading, of course, that pledge around $500 billion of investments in data centers and infrastructure as part of Stargate, alongside, of course, Oracle, OpenAI and MGX of the Middle East. So we're looking at $16.5 billion. That's what we're hearing in terms of reporting, in terms of this loan size. Part of that could be put to the $40 billion in terms of its investments into OpenAI. Part of that investment round that OpenAI has announced with that $300 billion valuation, part of it as well into that $500 billion, part of that move towards that $500 billion worth of investments as part of Stargate. Interestingly, the credit agencies in Japan and S&P as well have come out and suggested that this could weigh on the profile, the credit profile of SoftBank going forward.
Yeah, the outlook put to negative. A fascinating story. Bloomberg Daybreak Europe anchor Tom McKenzie, we thank you so much for your time this morning. And coming up, we're going to catch up with Kevin Mahn of Hennion Walsh. That's next. This is Bloomberg. From our global headquarters in New York, welcome to the Bloomberg Brief. I'm Sonali Basak, in for Danny Berger. Let's set your agenda. Now, U.S. stocks have wrapped up the first quarter, trailing the rest of the world by the most since 2009. The rout continues as tariff day looms. And the CHIPS grant in limbo. Commerce Secretary Howard Lutnick may withhold CHIPS Act funding to push firms to expand U.S. projects. And SoftBank is said to be seeking as much as $16.5 billion to fund AI investments in the United States. Let's get you in on the check of the markets, because you're looking at futures trying to catch a bid in the S&P 500, basically flat on the morning. NASDAQ futures, though, riding a little higher, up about 0.2%, though the Russell 2000 roughly flat. The bid in the bond market has continued, and the 10-year yield has stayed firmly below that 4.2% level, hanging around 4.18. The 2-year roughly flat on the morning at 3.87. We're now going to bring in Kevin Mahn. He's the president and CIO of Hennion Walsh Asset Management. That bond market move has been pretty stunning relative to the stock market move.
Certainly has.
It looks like if there's something to buy, people are going straight to the bond market. But should you face inflation? This is where my question is. Does that move make sense to the tune that we're seeing it?
Yeah, I think a lot of investors are happy to see March end and the first quarter be behind us. It was the most difficult March and first quarter since 2022, as we've seen a return of volatility that was largely absent in 2024. In fact, in 2024, the market moved by 1.5% or more lower on a given trading day, just 4% of the time. Thus far this year in 2025, that's quadrupled to nearly 16% of the time. That's significant volatility. So investors are fleeing to safety right now, or in some situations, going to the sidelines completely. And as we know, I've been doing this now for well over 3 decades. You can't time the market. It's more important to be in the market than it is to try and time when to get out of the market and get back in. But it's an indication of where investor sentiment is right now leading into the second quarter of the year.
Right. I mean, you look at the S&P 500, and it had been hovering around that 5,500 emotional barrier, if you call it that. You have seen others like JP Morgan call a low of as low as 5,200.
Yeah.
Where do you believe the low is?
I think all of the bad news is priced in at this point in time. And if I could use a basketball analogy, since we're within March Madness right now, I'm going to create a final four of factors that I believe could take place in the second quarter of this year and could lead to a stronger second half of the year. First, tariffs and trade. Now, I don't know where we're going to end up with tariffs. We're going to learn more tomorrow in terms of how reciprocal those reciprocal tariffs are. But once we know what the tariffs are, investors and business owners can plan accordingly. Two, the Federal Reserve indicated just last week they stand at the ready to step in if the economy deteriorates further. And I believe that that first potential rate cut of 25 basis points may still be on the table for June of this year. If, in fact, we get an extension of those job or tax cuts. If we don't, that could amount to the largest tax increase in our country's history. And then finally, the last factor, and perhaps most important factor, continued investment and continued spending related to both defense and AI infrastructure.
You know, I can understand why investors want to move on and start talking about taxes now. It's a huge thing to look at around the corner. But how do you factor in just how to think about tomorrow? It was the point for a while here that investors thought April 2nd would start to reduce uncertainty. That notion's starting to go away pretty quickly.
Yeah, the only thing that's certain right now is that there's going to be more uncertainty. At least we'll learn more tomorrow about, again, just how reciprocal those reciprocal tariffs are, what countries, what goods and services will be impacted, and perhaps we'll get some indication about what may be coming down the road. That's incredibly important to investors as it removes at least one element of uncertainty. It's also important to business leaders as well, as they need to plan accordingly.
But how do you move your portfolio around the tariff decisions in particular?
So I would look at the underlying themes that are in place regardless of tariffs, also factoring in the potential impact of tariffs. So I think about what themes are really generating market returns leading into all this tariff talk. And I go back to defense spending. For one, a lot of people thought DOGE was really going to cripple defense spending. It certainly has brought down the Department of Defense, but we continue to see more contracts being signed with the likes of Boeing and Lockheed Martin. And then we're learning overseas that the European Union is planning another $800 billion increase in their own defense spending capabilities, and that benefits companies like BAE Systems. So there are opportunities there, and you shouldn't necessarily just react to the headlines to reposition your portfolios. But to your point, it does remind investors of the importance of diversification, using allocation to help smooth out some of these bumps and help you meet their longer-term goals.
You know, if we were talking about 6 months ago, the one thing we would be talking about the most is AI.
Yes.
At this point, do you think that there has been way too much of a bid in these AI-focused companies, and are these trades bound to sputter further?
The way I look at it, it's the AI revolution has a long road ahead filled with many potholes, and there'll be many winners and perhaps even more losers. But if I look at all large cap technology companies, they're not pulling back right now. They're doubling down, committing tens, if not hundreds of billions of dollars into building out their AI infrastructure plans. So when I see the Mag 7 now trading at roughly 27 times current earnings, that's the lowest they've been since the end of 2022. That represents an attractive buying opportunity to me.
You know, it's interesting, but how much uncertainty is there, too? Because we were talking this morning about how the Commerce Secretary has now put that CHIPS Act money in limbo for a number of companies. Do you think that puts pause on the trade even further?
It certainly makes you think about it, right? Because the supply chain is interconnected within the overall AI ecosystem. We talk about NVIDIA, which is leading the whole AI revolution, and I would argue is the hub of the AI ecosystem. But they don't make their own chips. Taiwan Semiconductor is the largest dedicated chip foundry in the world with a 60% market share. Their biggest client is NVIDIA. But Taiwan Semiconductor doesn't do their own lithography. They use ASML. So you can see the interconnected value chain that exists within the overall AI ecosystem. So it does matter, and I do have to pay close attention to that. But AI isn't stopping. If anything, there's going to be more investment opportunities down the road, and large cap technology has the balance sheets and they have the wherewithal to stick to it, pivot, and adjust accordingly.
Kevin, great to have you this morning. That is Kevin Mahn of Hennion and Walsh joining us here on set in New York. Now, coming up, we've been talking about that CHIPS news. Commerce Secretary Howard Lutnick puts U.S. chip grants in limbo. We're going to give you details on that Bloomberg scoop next. This is Bloomberg. This is the Bloomberg Brief, and I'm Sonali Basak in New York. Now to a Bloomberg scoop. Commerce Secretary Howard Lutnick may withhold grants promised in the CHIPS Act that would push companies to invest more in the United States. And the idea here is to bring a carrot here to go along with the stick. President Trump has indicated that he wants to scrap the act and use tariffs as an incentive for more U.S. investment. For more, let's get in Bloomberg's Michael Shepard in Washington. This administration more and more looks like the stick approach might be the way to step forward, moving forward, at least on the onset. What would this do to have that type of pressure on companies in terms of withholding these funds that were promised?
Well, for the Trump administration, what they're hoping is that they're going to see more deals by using a stick like not only tariffs, but the threat of withholding some of this money to get semiconductor makers like TSMC, like Intel, like GlobalFoundries, like Samsung, to not only make good on previous commitments that they have made to put plants here in the U.S., but to add to them. They want them to double down. And we saw an example of that last month. We had Taiwan Semiconductor Manufacturing CEO C.C. Wei come to the White House and announce an additional $100 billion investment plan in the U.S. That's on top of a $65 billion commitment also. And look, Shonali, this was made at a time when we were thinking of tariffs as perhaps the only stick that the Trump administration would wield to encourage companies and encourage businesses to move and house more of their work here. But now we're seeing the CHIPS Act maybe being thrown into play, too. And remember that a lot of the money that was committed under the CHIPS Act that Joe Biden signed in 2022 hasn't actually been paid out. Companies have to meet benchmarks, and it'll take years for them to do so. So the government is actually sitting on a number of those checks, and it can use them, maybe in the Commerce Department's view, to get something out of it.
Mike, at the end of the day, is it that surprising to see them take aim at the CHIPS Act, given the controversy around some of it in the first place?
No, it really isn't. And also simply because it is a legacy program that was signed into existence by Joe Biden, it automatically has a chip against it, so to speak, in the views of Trump and his advisors. They spent a lot of time talking about and deriding other Biden-era policies, and this is one in particular that Trump has targeted. He has seen it as something that is really unnecessary, and he would like lawmakers to repeal it. Now, the chances of that happening are very slim. Congress generally supported it on a bipartisan basis. They like the idea of these subsidies, especially because the money goes back to their states and districts. And yet there are areas where they may try to make some tweaks and adjustments, and that includes areas like the tax credits that are also baked into it. And those tax credits hold a lot of appeals for the company, too.
Mike, I want to point out another move this morning because it's been interesting to see where the current administration parts from the last one and where it actually has something in common. This morning, you had that news break the wire, of course, that executive order that Trump had signed to crack down on ticket scalping and fees that have been driving up the costs of attending live events for consumers. The Biden administration had been looking at junk ticket fees as well. What does this move do to advance that pressure on live event companies?
Well, it's a great question, Shonali, because this is one of the few areas where we see the Biden administration and Trump administration actually have some common ground in the exercise of economic and consumer-oriented policy and enforcement. Trump signed this order flanked by none other than Kid Rock. He is one of the highest profile entertainers to really be a full-on Trump supporter in an industry that generally has kind of turned a cold shoulder toward the president. But what Donald Trump wants the FTC and the Treasury Department to do is take a closer look at this market. One of the big complaints is that there are computer bots out there that are buying and rebuying and reselling tickets and driving up prices. And not only do consumers like you and I get the shaft, so to speak, we have to pay so much more to see entertainers, whether it be Kid Rock or James Taylor. The ticket prices are up across the board. But entertainers also say that they are not getting a cut of those proceeds. And instead, it is going to companies like Live Nation, which owns Ticketmaster, and SeatGeek and others that are now drawing scrutiny under this order.
Now, I want to go to the states as well before I let you go. We want the latest on the Wisconsin Supreme Court race, the House special elections in Florida. There's a lot to watch across the country this week.
Well, absolutely. And these will be referenda on how the country so far is viewing the Trump administration in its early days. And why is that? And in Florida, let's take a look there. This is an election to fill the seat that was held by Mike Waltz. Now, that could be viewed as maybe a safe Republican seat. And yet we're watching the Democrat actually wage a pretty tight race against the Republican contender there. And then turning to Wisconsin, this is over the Supreme Court in the state. Elon Musk, who was one of Trump's closest advisors, he was his biggest financial backer during the 2024 presidential election campaign, and he also helped support a number of congressional candidates. He has put a lot of effort and money and time into trying to make sure that there is a Republican victor at the end of the day in this Wisconsin Supreme Court race. And control of that, Elon Musk says, is essential to ensuring that the president's agenda and the conservative agenda take hold in this state, which is seen as a crucial swing state in presidential elections, but also it's one that, they want to make sure that there is congressional representation that is majority Republican here in Washington from Wisconsin.
Certainly a lot to keep your head around when you think about all the moves in Washington on the state level. Bloomberg's Mike Shepard in Washington. We thank you for your time. And now we're going to bring you into another Bloomberg scoop because U.S. automakers are now making a last-ditch effort to sway the Trump administration on tariffs that are set to affect this week. Brendan Murray, who leads our global trade coverage, joins us now. Down to the finish line, ultimately. Of course, automakers are going to be heavily affected, and not just from the first set of tariffs, but of course, that talked about next set of tariffs that could also impact the parts. What can they do at this juncture, Brendan?
Well, what they can do is plead to the Trump administration that if they go ahead with what's proposed, it's going to lead to job losses, delayed investment, and weaker profit outlooks. So the auto companies we're reporting today are making that case to the administration. They're facing tariffs of 25% starting on Thursday on fully built cars from abroad and car parts in early May. So sort of a double whammy there. And on top of those tariffs, you'll have the reciprocal levies that the president is going to announce tomorrow on various trading partners from South Korea to Japan to the European Union. So the automakers are trying to make their case that they're the ones who are really going to take it on the chin, and it will be counterproductive for the administration to go through with these if what they want is a revival of the manufacturing base in the U.S.
There is a level of specificity to their demands or requests, rather, that are worth pointing out. They're looking for exemptions on low-value parts, electrical wiring, things that could be labor-intensive. Do you see the ability for some concessions?
Well, the administration has signaled so far that it's not open to any exclusions. During the president's first term, there was a massive program for exclusions that they think they've learned their lesson from. That if you provide all these loopholes, that you can't really accomplish what you want to accomplish. So we'll see how much of the case that the automakers are making that the administration takes on board. But as far as we can tell right now, those tariffs go ahead Thursday, and again, the car parts kick in on May 3rd.
Brendan, we thank you so much for all of your time this morning. That is Bloomberg's Brendan Murray. And there's another story, of course, we're tracking as well, a multi-billion-dollar one, SoftBank's AI push. The company is seeking a record loan of as much as $16.5 billion to fund AI investments in the United States. For more, we're going to bring in Bloomberg's Tom McKenzie. And $16.5 billion, we've seen SoftBank go to the banks before for large loans. This, though, would be a record. So how much inclination would there be to get this done, particularly given how risky the broader environment is right now?
Yeah, Shonali, to your point, look, it's an indicator that Masayoshi Son and SoftBank continue to go all in on their AI bets, despite some of the questions being raised by analysts around data center build-out by Microsoft, despite the questions being raised by the president of Alibaba pointing potentially to a bubble when it comes to data centers. SoftBank, Masayoshi Son, still going full bore on their AI bet, raising $16.5 billion US. And as you say, look, he's pretty adept at raising debt to put towards his big bets, and this is another example of that. Part of the money, we understand, will be going towards that $500 billion Stargate effort that SoftBank is leading alongside Oracle, alongside OpenAI and MGX in the Middle East. Part, it seems, will be going towards their backing, their ramped-up backing of OpenAI, which has just announced it's raised that $40 billion US at a $300 billion valuation. So we'll see exactly where the chips lie. There is, of course, a question mark in terms of what this does to the credit profile. Some ratings agencies have come out and said this does look like it's going to deteriorate and weigh on the balance sheet of SoftBank, and you've had some credit rating downgrades on the back of that. The stock in the session over in Japan largely unmoved on the back of this, but that could be a longer-term contention if, of course, these bets don't turn around, or at least turn profitable in fairly short order for Masayoshi Son.
Now, do we know how he's going to look to obtain this loan? It looks like it's going to be a bridge loan with a 12-month tenure. Do we know why they're doing that, given that, to your point, they're looking at a credit outlook on the decline?
Yeah, so it's got that 12-month outlook, which is why I referenced, needing to see these returns in they can't be pushing out and building out a view that they're going to be getting returns in 5-10 years time if they got a 12-month tenure on this debt. Look, they have assets, right? SoftBank, they have the assets in Japan in terms of the telecoms business. They have, of course, their stake in Arm Holdings, headquartered in Cambridge, UK, of course, with the listing in the US. And then, of course, they have this stake now in OpenAI. So the assets are there for SoftBank that they can leverage to raise this kind of capital. It's not clear exactly why they've gone for a 12-month tenure and not pushed for a longer term. You can assume that it's down to the credit, or at least the details of the deal that they're getting from their creditors. But again, it's just a reminder that for some of these big players, they have not yet been constrained by some of the concerns in the market about the return on investment around AI, about return on investment around the infrastructure spend and the data center build out.
Right. Interesting that, of course, it is indeed a bridge loan, not a margin loan against those assets. Of course, asset prices these days pretty volatile. Bloomberg Daily Europe anchor Tom McKenzie, we thank you so much for your time this morning. Now, coming up, we're going to get you set up for your trading day. Of course, a lot to look for ahead of Liberation Day. This is Bloomberg. This is the Bloomberg Brief, and I'm Sonali Basak in New York. We're going to give you a look at what's ahead today. Richmond Fed President Tom Barkin speaking at 9 a.m. Eastern Time. And U.S. auto sales numbers begin to drop at 9 a.m. And we're going to have U.S. PMI and JOLTS job openings at 10 a.m. Bringing you some movers under the surface as well. Pre-market in the United States, Live Nation falling after President Trump signed an executive order aimed at cracking down on ticket scalping and fees that drive up the cost of attending live events. We're also taking a look at Johnson & Johnson, also down after a federal judge rejected the firm's attempts to use bankruptcy to end cancer claims. And Newsmax is extending double-digit gains after its blockbuster debut on Monday. Looking at some macro movers as well, I wanted to take a look here at the bond market because it's interesting to see here that the U.S. two-year yield hanging firmly below 3.9%, but pretty much flat on the morning. You are seeing that bigger bid into the longer end of the curve. The 10-year yield dropping down to 4.18, down another 2 basis points after a 4 basis point move on Monday. The 30-year yield also catching a move of almost 3 basis points lower. Now that's it for the Bloomberg Brief this morning. Bloomberg surveillance is up ahead, counting you down to those tariffs. This is Bloomberg.